clients operate foreign branches, there's a good chance they're facing a required Section 987 calculation this year. The good news, that same calculation may uncover a tax benefit many companies don't realize they have. I'm here with Greg Lambrecht and Ashu Mahal, part of our GBS international team, and they're going to walk us through some of the key aspects of 987. So, Greg, Ashu, whoever wants to field this, why does this matter?
The new regulations were issued in late 2024, which were finalized regs. At that point, they required us to switch to the new methodology, which required us all the QBUs that were outstanding as of December 31st, 2024, to be considered deemed terminated and calculate FX gain loss as of December 31st, 2024. And then going forward, under these new regulations, we are required to use new methodologies to do the calculations annually.
Key thing there is a lot of our foreign disregarded entities, which you refer to as QBUs, were previously no one really cared or did a very nominal calculation around 987. And with the new regulations that were finalized, it's not an optional transition. These have to be done for tax years that ended 12/31/2025. So I think that's a key distinction from what was generally happening in the past. And really the thing is, it's not about just filling out another IRS form. It's really making sure that you get this calculation done correctly. And there's some information. I think one of the things we want to mention to the listeners is that they can look at Notice 2026-17, which will provide, quite a bit of information there.
Okay. Well, not being an international expert, this sounds a little complicated. What are some of the challenges people will face as they approach this?
The biggest challenges, as Greg mentioned, historically, people either did nothing or people did simplified calculations to track their FX gain loss under the 987 methodology. So now under the regs, to calculate the pre-transition gain loss, one of the requirements is that you have to go back to the inception of the QBU whenever it was formed to track all the pools to determine what's the gain loss that should be calculated as of December 31st, 2024. So in that case, the biggest challenge is like going back and gathering all the data to do this complicated calculation.
Yeah, I think another challenge is to determine some clients are exempt. So, for example, if you're in a partnership structure, you may not have to apply the full regulations. There's some exemptions there. A lot of foreign branches, maybe they don't realize that they qualify for this. So that would be one of the challenge. And I would say another major challenge is that the form looks simple, but the actual underlying calculation can be quite complicated. And we want to make sure that our clients are fully utilizing the actual the calculation to its fullest benefit. One of the things that has happened over the last 10 to 12 years in particular is that the US dollar has strengthened quite a bit. And there's a high possibility that when this calculation is done correctly, that our clients will be able to recognize a substantial foreign exchange loss and bring that into their U.S. tax return.
Okay, so this isn't necessarily just compliance, but due to the currency changes and whatnot in that environment, there's actually a tax savings opportunity here potentially.
Yes, I think there is quite a substantial opportunity for a lot of taxpayers, especially if they've had, foreign disregarded entities, again, these QBU units that have been in existence for 10 years or more. A lot of companies have disregarded entities that have been around a long time, and it's very, very likely that they have a loss that they could not only realize, but they can recognize.
Why are CPA firms calling us, Greg and Ashu?
Well, it's a really complex area, and then it's pretty much like a lot of complexity involved, especially like interplay with the other code sections. So for example, you calculate 987 loss, And then you need to figure it out. Where should it go on the return and what's the source of the loss? And it can interplay with the foreign tax credit calculations too, to understand how it impacts the other credits that's involved.
Yeah, so Ashu and I have a real world example. We have a client that, a CPA firm that's a client of ours, and he has a client that had, partnership in the US with stacked QBUs, meaning that he had a first tier QBU that owned another QBU, and there was a lot of analysis around how they were potentially going to sell in the future, and should they sell assets, should they sell the QBU itself, and the outcome was quite different based on the interpretation of the regulation. So
Okay.
firms are calling us, one, how it should be treated, and secondly, how the calculation should be done. That's what we're seeing.
Thank you, Ashu and Greg. Enjoyed the conversation today. And I think, to me, the overriding message is if you have clients with foreign branch operations, now's the time to look at 987, get in compliance, but also maybe uncover some tax savings and put some cash back into your taxpayers' business or your client's business. So much appreciated. And if anyone has any questions, please feel free to reach out to McGuire Sponsol's GBS team. Greg and Ashu would be happy to take your call and help you through any situation you're encountering with 987.